Meantime, investors are trying to navigate the flood of headlines around tariffs. Our next guest says the tariffs delayed doesn't necessarily mean tariffs canceled, and if implemented, they are likely to deal a meaningful blow to the U.S. economy while putting some upward pressure on inflation. Lizanne Sonders joins us this morning, Charles Schwab, chief investment strategist. Lizanne, you had some great data this morning just looking at trade uncertainty and sort of where we are right now relative to, say, the last 20 years.
Yeah, if you look at the U.S. Trade Policy Uncertainty Index, it's actually spiked up. It's not quite to the level we got during the 2018 trade war, but it's gone parabolic. Carl, I also wanted to pull on a couple of threads that you as a team there were just talking about. What's interesting to me throughout these past several days is, and I understand the focus on importers. I mean, they're the actual folks who pay the tariffs. It's U.S. importers that pay the tariffs. But there's been less focus on U.S. exporters. And the export side of our economy is 2.5% of GDP. And especially with retaliations, as announced by China today, I think that has to become part of the conversation. And then to your other point about growth in the economy, the desire, or at least one of the stated desires of tariffs, is to raise money in order to fund tax cuts. Anything that is done to boost the U.S. economy, be it on the tax side of things, deregulation, we are a net importer as a country. So you boost the economy, it almost automatically causes a decline in the trade deficit. So then the question is, what exactly is the yardstick by which the administration or others are measuring success of this? So there's a lot of cross currents right, that we're coming to grips with in the last few days.
I'm glad you mentioned that, because some desk notes this morning are diving into government accounting, and one element of that is you can't use tariff revenue to offset tax cuts unless it's codified into law. And no one knows where Congress is on this.
Exactly. Absolutely. Not to mention, if you think of, rightly so, as tariffs as a tax on U.S. companies, U.S. importers, then you're taxing them in one direction, but then the goal is to give them tax cuts, or at least the extension of tax cuts. So there's a lot of murkiness in how circular this is.
So can I ask you, are you impressed with the ability of the bulls to leap through these various crucibles of DeepSeek and tariffs and even the government policy noise we're getting out of D.C. these last 12 days? Has that been impressive at all?
It has been impressive, and it clearly suggests that there is still that buy the dip mentality. There is still money that wants to find opportunities. Now, keep in mind that in the first month of the year, you have had equal weight outperforming cap weight. So there has been obvious pressure on tech. Tech as a sector hasn't really done much since June, with some gyrations. You have seen some more quiet, stealthy participation in areas other than, say, the Magnificent Seven. So I think that's also healthy. And that was in place prior to what we're dealing with from a tariff perspective. But we still have these rapid fire sector rotations. I mean, just between yesterday and today, in terms of, tech at the bottom of the list, now close to the top of the list, the defensives yesterday at the top of the list, now at the bottom of the list. I think those sector related gyrations are going to be with us for a while.
Lizanne, we're just diving into peak earnings week. We'll talk again soon. Good to see you. Thanks.